Hey everyone, today we're diving into a financial product that was literally born from a classic retirement headache. And, it's one that's changed a lot since it first came out. So here's the big question, right? If you're getting close to retirement, or maybe you're already there, you're probably thinking about this all the time. How can I get my money to grow like it does in the stock market, but without the terrifying risk of losing everything in a crash? I mean, it's the ultimate financial tightrope walk, isn't it? And look, that fear, it's totally normal. Of course it is. You see the headlines, you see the potential for big gains, but man, the idea of a market crash just wiping out a huge chunk of your nest egg, that's a nightmare. Well, this is the exact problem that a very specific kind of financial tool was invented to tackle. So, what is this thing? It's called the equity indexed annuity. The whole idea was to create this perfect middle ground, a way to dip your toes into market gains while having this, like an ironclad shield around your original investment. All right, let's get into the nitty-gritty. What exactly is an equity indexed annuity, or EIA for short? Think of it like this. It's a deal, a contract you make with an insurance company. And this deal promises you two really big things. First, you get the chance to earn returns based on how a stock index, like the S&P 500, does. But second, and this is the big one, it gives you a rock-solid guarantee that you will not lose your principal, no matter how crazy the market gets. Okay, so here's the secret sauce. This is how they pull it off. Your money, it's never actually in the stock market. Not a single penny of it. The insurance company just looks at an index, say the S&P 500, and uses its performance as a measuring stick to figure out how much interest to give you. It's a really clever setup, and that's the key to how they can offer both the potential for growth and that 100% principal protection. Now, you're probably thinking, okay, what's the catch? And you're right, there's always a trade-off. To get that amazing protection, the insurance company has to set some rules. These rules basically limit just how much of the market's good times you get to enjoy. It's kind of the price of admission for that safety net. So let's break down these rules of the game. First up, you've got something called the participation rate. It's exactly what it sounds like. It's the percentage of the market's gain that you get to participate in. So let's say the index has a great year and goes up 10%. If your participation rate is 80%, well, you get 80% of that 10% gain. That means your account gets credited with 8%. Pretty straightforward, right? All right, next rule, the cap rate. Think of this one as a ceiling on your earnings. The market could go absolutely wild. Let's say the index shoots up 10% or even 20%. But if your annuity has a cap of, say, 6%, then the most you can earn that year is 6%. It's a hard limit on your upside. But now we get to the most important rule of all. This is the whole reason people look at these things, the floor rate. And almost always, the floor is set at 0%. So what does that mean? It means if the market has a truly awful year and the index plummets by 20% or 30%, your account simply earns zero. You don't make any money, sure, but, and this is everything, you don't lose a single dime. Your principal is completely safe. Zero is your hero here. Okay, so now you know the basics of how these equity indexed annuities work. But hang on, because there's a huge plot twist here. This is something you absolutely have to know if you're considering one of these today. The game has changed. The original EIA, well, it evolved. So here's the bottom line. That product we just described, the EIA, you can't really buy it anymore. That was kind of the version 1.0, popular way back in the 90s. Today, the modern version is called a fixed index annuity, or FIA. So you might still hear people throw around the old term, EIA, but what they're actually selling and what you'd be buying is the newer, updated FIA. Think of the FIA as the direct descendant, the modern upgrade to the old EIA. It's built on that exact same foundation, growth potential with protection, but it's been tweaked and improved over the years. They've made them more transparent and frankly just a lot more friendly to the consumer. So what's new and improved? Well, modern FEIs have some pretty cool upgrades. You can now find strategies with no cap, which means more potential for growth. You get a much bigger menu of indices to choose from, not just the S&P 500. And a lot of them have lower fees, sometimes even no annual fees, and the contracts are just easier to understand. But maybe the biggest deal is the option to add on things like a guaranteed lifetime withdrawal benefit, which is a fancy way of saying you can turn it into your own personal pension that pays you for the rest of your life. But even with all these cool new features, the core idea behind the modern FIA is still the same. It's all about a fundamental trade-off. So let's put it all out on the table. What are you getting and what are you giving up? All right, let's break it down. On the pro side, the benefits are huge. You get 100% protection for your principal. You literally can't lose your starting money to the market. All your growth is tax deferred, which is great, and you have that option to create a guaranteed income you can never outlive. Now, on the con side, this is the price for all that safety, your growth potential is limited. Those caps and other things will hold back your returns in big market years, and they're not liquid. If you need to pull your money out early, you're going to face some pretty hefty surrender charges. So where do these FIAs fit in the big picture with other safe money products? Well, think about a traditional fixed annuity or a MIGA. Those are kind of like a CD from an insurance company. They give you a set guaranteed interest rate. An FIA is different. It gives you a variable return that depends on the market. But here's the key thing they all have in common. Your principal is safe, and you're not directly exposed to stock market risk. Okay, so after all of that, we finally get to the million-dollar question. Is a fixed index annuity actually right for you? Let's run through a quick checklist to see if it might be a good fit. So, an FIA could be a really good match if you find yourself nodding along to this. You're close to retirement, or maybe you're already there. Your number one goal is, don't lose my money. You get heartburn every time you see the stock market take a dive, but you still want your savings to grow a little. And the idea of having a guaranteed income check later on sounds pretty darn good. If that sounds like you, then yeah, this is definitely something to explore. Now, on the flip side, you should probably steer clear of an FIA if this sounds more like you. Your main goal is getting the absolute highest growth possible, and you're okay with the risks that come with investing directly in stocks. Or maybe you know you'll need access to all this cash in the next few years. If that's the case, the surrender charges would be a killer. Basically, if you want full market growth and full liquidity, an FIA just isn't the right tool for that job. So at the end of the day, it all boils down to one simple but really powerful question you have to ask yourself about your retirement savings. What's more important to you? Is it the chance for unlimited growth, even if it means you could lose big? Or is it the absolute guarantee that you will never, ever lose your hard-earned money? There's no wrong answer here, but figuring out which one matters more to you, well, that's the key to everything.